Hello, good evening, everyone. Like I promised, I am right now going through the answer to the question case 5.58. So please make sure that you will follow my steps to work on this question. So the first question, I trust you have spent some time to read this question. So the first question is to calculate the company's 2022 budgeted manufacturing overhead rate using direct labor cost as the single rate and the 2022 budgeted costs and selling prices of 500 grams of mocha coffee and 500 grams of vanilla coffee. Okay, that's the first question. So we are using a single rate. That means this is the traditional costing, right? We only use one single overhead rate. So let's take a look. So in the question, we were told on the very top, there is a table on page 5-52. Okay, on that table, you can see that the budgeted overhead cost is 3.5 million. Okay, and then since they are using direct labor hours, direct labor cost as the cost driver, so the budgeted direct labor cost totals 700,000. This is just kind of close to the second paragraph on page 5-56. Sorry, on page 5-51. The second last paragraph, and in that paragraph, the second last line tells us the budgeted direct labor hour cost totaled 700,000. So both information are provided by the question. So when we calculate the single overhead rate, we are using 3.5 million divided by 700,000. So we get a 500%. Okay, that's the overhead rate of the direct labor cost. In the question, the information provided that each unit is 500 grams. That's the weight for each unit. The direct material costs are given, and the direct labor cost per unit are given. So the overhead applied, so that's the direct labor cost times 500,000. Okay, so what's that going to be? 500,000, 500% times 0.25. So I have 1.25. That's the overhead. So then when you add up all the three components of the product cost, the full cost is 4.7 from mocha and 4.3 from vanilla. And then they are trying to make a 20%, make a profit equal to the 20% of the cost. So 25% of the product cost here, 1.18 from mocha and 1.08 for vanilla. So then the cost plus the markup, that's your selling price. So $5.88 for mocha, vanilla $5.38. So remember, this is per unit, and each unit is 500 grams, right? It's not 1,000 grams. Each unit is only 500 grams, not 1,000 grams, okay? So that's the first part. The second question, we need to compute the overhead rate, okay? So we are using the controller's approach. So this is the step 3, okay? We want to figure it out. You know, there are different activity cost activity pools: purchasing, materials handling, quality control, roasting, blending, and packaging. Okay, so that's the 6 cost drivers. Okay, so we are using step 3. Step 3, we are using division based on the information provided on the table on page 5-52. We can figure it out. The cost is $500 for each purchase order, and $350 for each setup, $300 for each bench quality control, and 9.50 cents per hour for roasting, $20 per hour for blending, and $25 per hour for packaging. So this is my step 3. I'm trying to figure out what are the predetermined overhead rates for the different activities. And now I want to know what's the actual use to make 50,000. What's the actual use of these cost drivers in order to produce 50,000 kilograms Mocha and versus 1,000 kilograms of vanilla. So each purchase order can only purchase 12,500 kilogram, and in order to obtain 50,000 kilograms this materials, so then I need to have 4 purchase orders. Each order is not enough. I need to order 4 times in order to obtain 50,000 kilogram. Okay, and so for the number of benches, so each bench, the quality control is for 50,000 kilogram. So you only need 1 bench, okay? And the setup, okay? For each bench, you need 3 setups, okay? So 3 times 1, that's 3 setups. Roastings, it takes 1 hour to roast 50 kilogram, okay? So in order to roast 50,000 kilogram, you are going to need 1,000 hours. Similarly, each, in order to blend 50 kilograms, you need half an hour. So to blend 50,000 kilograms, you are going to need 500 hours, okay? For packaging, you're going to need 100 hours, okay? So this is just how we figured out the actual use of the cost driver, okay? So we know in order to manufacture 50,000 kilograms Mocha, you need to have 4, these are the cost drivers, you need to have 4 purchase order and 1 benches of quality control, 3 machinery set up, 1,000 roasting hours, 500 blending hours, and 100 packaging hours. Using a similar idea, you can figure out in order to manufacture 1,000 kilograms of vanilla, you need 4 purchase order and 4 benches, 12 machinery set up, and 20 hours roasting, 10 hours blending, and 2 hours packaging. Okay, so now we know all the actual use. Now let's go for the step 4. Let's calculate the allocated overhead cost. So for example, Mocha, you have $400 per order. Okay, these numbers, 400, 500, 3, 350, 9.5, we have calculated here, okay, on step 3. So now let's apply this standard rate and using the actual cost driver. So for example, per order cost 500. I need 4 orders for Mocha and 4 orders for vanilla. So 4 times 500, I need the cost will be $2,000 for each. Okay, so I'm going to need 1 bench for Mocha and 4 bench for vanilla. So 1 bench Mocha, so that will be 300, and 4 bench, that will be 1,200. So in the same idea, you just apply the actual use of the driver and we multiply it by the standard rate. You figured out what is the allocated cost. So the total overhead I assigned when I add up all the 6 assignment, that's 25,350 for the Mocha and 6,840 for vanilla. Okay, So I want to figure out what is the overhead cost per kilogram per 1,000 gram. So I use the cost divided by 50,000. So I have almost 51 cents, okay? And the similar idea, the overhead cost per kilogram is $7.84, okay? So that is this calculation. So now when I compare the two methods, okay? In the first one, here, we figured out the cost is under the traditional costing. The full cost is 4.7 for mocha and 4.3 for vanilla. But remember, this is the cost per unit, and each unit is only 500 gram. Okay, so what's the cost? We know the cost for 500 gram. What is the cost for 1,000 gram? Okay, 1 kilogram. So that would be 4.7 times 2, 4.3 times 2, okay? So then when I take a look at the cost per 1,000 gram per kilogram, traditionally mocha would cost 9.4 and vanilla would be 8.6. But under ABC, the full product cost is 7.4 for mocha and 13.9 for vanilla. So you can see that's a quite big difference, right? That's a quite big difference. Okay, so basically, which volume is high volume? We know vanilla is a low volume, right? There's only 1,000 kilogram versus mocha is 50,000 kilogram. So relatively, vanilla is a low value product. Mocha is a high volume product. Okay. So what happened is you can see this low volume product is under cost under traditional, right? So the cost is 8.6 under traditional, significantly lower than the ABC, right? 13.94, okay? And the traditional costing overcost the high volume product. Okay, so the high volume product is this mocha, okay? So it should be 7.41, but traditionally the overcost the mocha 9.4, okay? So what is the implication, right? The whole idea is that low volume product, the vanilla, they are using the resources, but they are not covering their shares of the cost of these resources. So that therefore it's under cost. They are using the resources, but they were not allocated with that usage, right? So therefore it's under cost. Okay. And what's the vanilla is priced? The vanilla is priced in the part 1, 5.38, but that's only for 500 gram, right? So you have times 2 to figure out what's the 1,000 gram. So that number times 2. So for vanilla, for every kilogram, it's cost 10. The selling price is $10.76. This is lower than the cost, 13.94. Okay, so they are losing money on their vanilla. The company should set long run price above the cost, right? Of course, you wish your price will be higher than your cost, right? Okay. So if this is a new product, okay, you are trying to start a new market. Of course, right, when something is new, the market probably doesn't know about this product. Therefore, the volume, the demand is small, okay? So in the beginning, this is a low volume, right? But if you believe that, in the long run, right? In the long run, when you start build the brand and there will be an increase in the demand for this product, so then the product will switch from a low volume to a high volume product, right? So therefore, the cost will be allocated, right? The cost will be allocated when the volume is higher. The cost per unit will be allocated, right? Remember, if lots of the overhead costs are fixed cost, right? When the production unit, the volume increase, the cost per unit will decrease, right? So therefore, maybe the current price makes sense, right? In the future, when you are able to produce enough volume, okay? Because otherwise, what happened would be the high margin, high volume products, they are subsiding the low volume, low margin product, okay? So that is this question. So I hope everything makes sense. Have a good evening and good luck with your exam.